Let us look at another question illustrating the taxation of employment income. This is a question adopted from Public Finance and Taxation of CPA April 2022. The question reads as follows. John Wesonga is employed by Fadhili Limited as a finance manager. During the year of income 2021, he provided the following details to his income. Basic salary per month of 182,500. Monthly pay deducted by the employer was 47,200. He lives in a house provided by the employer, and 35,000 per month is paid by the employer to the landlord for the house. The employer furnished the house at a cost of 180,000. The employer deducted 5% of his basic salary during the year to cater for the house rent. He contributed 15,000 per month to a registered pension scheme, while the employer contributed 10,000 for him per month towards the scheme. He was reimbursed 250,000 for medical expenses incurred during the year. The medical scheme only covers employees earning more than 100,000 per month. He was given 45,000 as per diem for attending a 5-day seminar at Mombasa. This amount was to cater for his accommodation and meals. He has an education policy for his children where he pays 15,000 per month. He is entitled to an annual bonus of 5% of his basic salary. This bonus was paid in December 2021. Benefits provided to him by the employer during the year were as follows. Commuter allowance, 180,000. Meals, 35,000. Residence telephone bills, 60,000. Entertainment allowance, 120,000. Required taxable income of Mr. John Wesonga for the year ended 31st December 2021, and tax payable, if any, on the income computed in C1 above. Right, in this question, then what we can see is that we are required to prepare the statement of taxable income for Mr. John Wesonga. I want to adopt a different approach, or a very unique approach in answering this question compared to what I have done before. That in this question, in each and every statement that we shall be reading, I am providing a brief explanation. I'm providing a brief, maybe extract of the act to show us how to really treat each and every item. So we shall be treating each and every item based on what the act says about that particular item, which I've extracted here in short summary. Right, so let us start with the first item, which is basic salary and pay. There's not much we can explain about that, is that basic salary is just simply taxable. But then when you go to number 2, we are told that he lives in a house provided by the employer at 35,000 per month is paid by the employer to the landlord. That is this statement, number 2. The first part, which is talking about the house provided by the employer. And in case a house is provided by the employer to employee, that is a taxable benefit. The taxable benefit which is charged on the employee in the year of income is determined as follows. For ordinary employee or for whole-time service directors, the taxable benefit, housing benefit, is usually determined as the higher of 1, it is a higher of 15% of the total benefits from employment other than the employment benefit, or the fair rental value of the house, or the actual rent paid by the employer on behalf of the employee for that particular house. The higher of the 3. So we check whichever is higher. This is a benefit to the employee, but the benefit is the higher of the three will be a benefit. That is the first part of that statement number 2. In the second part of that statement number 2, we are told that the employer furnished the house at a cost of $180,000. This is called furniture benefit. And furniture benefit is also a benefit to the employee. Furniture benefit is a benefit to the employee. And therefore, that will be added as part of the benefits. But then the taxable furniture benefit on the employee, if provided with furniture by the employer, is 2% per annum of the cost of furniture or 1% per month of the cost of furniture. So that is also a benefit. The last statement, we are told that 5% of his basic pay was deducted during the year to pay for rent. This is known as nominal rent. And nominal rent is deducted from the rental benefit. So once we determine the rental benefit as the higher of the three above, the higher of these three above, we subtract 5% of his basic pay, which is nominal rent. Now, the treatment is housing benefit is that housing benefit usually comes after we aggregate all the other benefits from employment. Let us go to number 3. He contributed $15,000 per month to a registered pension scheme, while the employer contributed $10,000 for him per month towards the same scheme. Now, this is a deduction. Whatever he pays to the pension scheme is a deduction, which is a liable deduction. But what the employer pays for him is a benefit, but it is a non-taxable benefit. It's an exempted benefit. So we cannot charge, it's not being charged tax on the $10,000 that the employer pays on his behalf. But the $15,000 that he pays to the scheme is a liable deduction. And a liable deduction will be deducted from the pensionable income. The liable deduction will be deducted from the pensionable income. The amount which is deductible from the pensionable income is the lower of or the lesser of the actual amounts contributed to the pension scheme or the actual amount contributed to the pension scheme, or 30% of pensionable income, or the commissioner's maximum, the commissioner of domestic tax maximum, which is the CDT's maximum. The CDT's maximum is $20,000 per month or $240,000 per annum. That is the maximum amount that can be deducted. But if the maximum amount is higher than the actual, then the actual amount is deducted. Or if that is higher than the 30% of other employment benefits, which is the pensionable income, then 30% is deducted. So the lower of the three, whichever is lower. But now this is not a benefit, but this is a deduction. This is a liable deduction. And deductions come after determining the incomes. In additional information number 4, he was reimbursed $250,000 for medical expenses incurred during the year. The medical scheme covers only employees earning more than $100,000. This is also a benefit to the employee. However, medical benefit at times can be non-taxable and at times can be taxable, depending on the following. Where the employer provides free medical benefit, then to all employees, that is known as non-discriminatory medical scheme. The value of such benefit is non-taxable on the employees. But if the medical benefit only caters for some employees only, that is discriminatory medical scheme. If it is discriminatory medical scheme, then it is taxable on the recipients only. It is only taxable on the employees who are receiving such benefit. Otherwise, if it covers everyone, there's no taxation. If it covers only a few, it is taxable on the few who receive the benefit. Now, this is a benefit which will be taxable in this case because in this case, it is discriminatory. We are told that the medical scheme covers only employees earning more than 100,000. That means it is discriminatory. And in this case, therefore, we say this is a benefit, and it is a benefit which is taxable on this employee. In addition, information number 5, we're told that he was given 5,000 as per diem for attending 5-day seminar at Mombasa. This amount was to cater for his accommodation and meals. For per diems or an amount, a per diem is cash allowance, which is given to an employee for working out, who is working outside his or her workstation. When an employee is working outside his or her workstation, then they may be facilitated for accommodation. They may be facilitated for meals by being provided the meals. And this facilitation is not taxable in Kenya up to a maximum of 2,000 shillings. Anything in excess of 2,000 shillings is taxable. In case of this employee, he was out for 5 days and was given 45,000. That means an average of per day 9,000. And in that case, there is an excess. The excess is 9,000 minus 2,000. That is 7,000 per day. In other words, 2,000 per day times the 5 days that the employee was on duty outside their workstation, that will be 10,000. So we subtract 10,000 from 9,000, we remain with 35,000. 35,000 is like 7,000 per day multiplied by 5. Now, this is part of the taxable benefit. The per diem will be part of the taxable benefit. In number 6, we are told that he has an education insurance policy for his children, where he pays 15,000 as premium per annum. This one here is a deduction, but not a deduction from income, but a deduction from tax, which is known as a relief. So this is an insurance relief. Insurance relief is deducted directly from the tax that has been determined. Now, in this case, then, where a resident individual is as an insurance policy, they are entitled to a relief at the rate of 15% of the premiums paid, subject to a maximum of 5,000 per month or 60,000 per annum. Now, for this premiums or 15% premiums to qualify as a relief, then there's some conditions that must be fulfilled. Like one, the policy must be a policy covering the life of the individual, the life of their spouse, that is wife or husband, and then the life of dependents such as children. Then the insurance policy must be a policy that is having a maturity period of at least 10 years or more, not less than 10 years. Therefore, in this case, this will be a relief, which is deducted directly from the tax determined. And the relief is 15% of the premiums paid, subject to a maximum of 5,000 per month or 60,000 per annum. In number 7, we are told that he is entitled to annual bonus of 5% of his annual basic pay. The bonus is also part of the benefit. In number 8, we told that benefits provided to him by the employer during the year are as follows. Commuter allowance, this is a taxable benefit. Meals, taxable benefit. Residence, telephone bills. taxable benefit, entertainment allowance taxable benefit. But I would like to explain two of them. The first one is telephone bills, and telephone bills are taxable benefit, but only 30% of the telephone bills is a taxable benefit. 30% of the taxable benefit is the taxable benefit. Then for meals, this is known as benefit in kind. And this benefit in kind, it is taxable, but the first 3,000 per month or 36,000 per annum is not taxable, is exempt. In this case, the employee received meals worth 35,000, and 35,000 is less than 36,000. That means the meals will not be taxable because the value provided is not more than 36,000. The first 3,000 per month or 36,000 per annum is not taxable. Anything more than that or any excess amount is now taxable on the employee. Therefore, the 35,000 will not be taxable because it's less than 36,000. Allow me then now to go ahead and solve the question as required. We are required to determine the taxable income, and we do so by preparing the statement of taxable income. We prepare the statement of taxable income. So we say, this is Mr. John Wesonga. Mr. John Wesonga, statement of taxable income. For the year 2021, statement of taxable income for the year 2021. Right, so we start with the incomes one by one. The first one is basic pay, which is in the additional information number one. In number one, we are told that the basic pay per month is 182,500. Monthly pay is deducted at 47,200. So let us start with the basic pay, which is 182,500. So basic pay is 182,500 times 12. 182,500 times 12. That is the basic pay per month. It's 182,500. If we multiply that by 12, we should be having 2,190,000. Followed by the next benefit, which is in number two. In number two, we have two items. We have the housing benefit and we have the furniture benefit. The housing benefit will come later after determining all the other employment benefits. So we start with the furniture benefit, therefore. For the furniture benefit, we have 12% of the cost of furniture. And the cost of furniture, in this case, this question is 180,000. That will therefore simply be 180,000 by 12%. That is 21,600. And the next one is all the way to number 3. In number 3, we have a deduction and not a benefit, so we don't need to add that. We are still determining the benefits. In number 4, we have a benefit, the medical benefit, and we determine that it's taxable because it is a discriminatory medical scheme. It is a discriminatory medical scheme. So that is why it is taxable. Medical benefit equal to 250,000 as the reimbursement here. So the reimbursement of 250,000. So we have 250,000. The next one is number 5. He was given per diem, and we have analyzed this per diem as follows. That per diem is taxable on the excess amount above 2,000, and that is 7,000 by 5. That should be 35,000. Excess per diem is 9,000. Sorry, should not be 9,000. Should be 45,000 minus 10,000, which is for the 5 days, 2,000 per day. And that should give us 35,000. 9,000 minus 2,000, or 45,000 minus 10,000. 10,000 here is 2,000 per day, which is non-taxable, times 5. That is 10,000. Subtract it from 45,000. We multiply 2,000 by 5 because he was out of his workstation, working outside his workstation for 5 days. Each day has allowable income, as a non-taxable benefit of 2,000. Anything in excess of the 2,000 is taxable. Now, to determine what is taxable, we subtract the 2,000 by 5, which is 10,000, from the total so that we get the excess. And the excess per diem is 35,000. He has an education policy for his children where he pays 15,000 15,000 as premium per month. This is a relief and therefore not a benefit. He's entitled to annual bonus of 5% of his basic pay, of annual basic pay. This is a taxable benefit, so we add it, the annual bonus. That is equal to 2,190,000. 2,190,000 times 5%. Now, 2,190,000 times 5% equal to that one equal to 109,500. That is 109,500. 2,190,000. 2,190,000 we have multiplied by 5%, and that is equal to 109,500. The next taxable benefit here is the commuter allowance. Then we have residential electricity bill, and then we have the entertainment allowance. So we have commuter allowance is 180,000. Then you have telephone benefit. Telephone benefit, which is taxable, is usually 30% of the telephone bills. So in this case, the telephone bill is 60,000 multiplied by 30%. 30% of 60,000 should be 18,000. Next is entertainment allowance. Entertainment allowance was equal to 120,000. That is part of the taxable cash allowances. That is a taxable cash allowance. Now, until this point, then we can go ahead and determine the taxable income before rental income. We have not added the rental income, but we need to get the other taxable incomes before determining the rental income. Now, the total is 2,924,100. That is total employment income before housing benefits. Let us then add housing benefit. The housing benefit is the higher of. The higher of, number one, we have the 15% times total employment benefit, which is 2,924,100. 2,924,100. Compare it with the actual rent, which is paid for the house. Actual rent was 35,000. Actual rent was 35,000 per month. Now, 35,000 per month, we need to determine the annual benefit, which is 35,000 by 12, and that is 420,000. And 15% of the total employment benefits before the rental benefit or before the housing benefit is equal to 438,615. Now, looking at the higher of the two, we take 438,615. So 438,615, which is 15% of other employment benefits, is the highest, is the higher of the two. We don't have the market rental value, so we can't use it. But after determining the rental benefit, we need to subtract nominal rent, which was paid. And the nominal rent is 5%. The nominal rent is 5% of the basic pay. Is written here. If you look at additional information number 2, the nominal rent is 5% of the basic pay. So we're going to use that nominal rent of 5% of the basic pay. The basic pay was 2,190,000. So we have 5% of 2,190,000, and that will be equal to 2,190,000 times 5%. That is equals to 109,500. So this we deduct because he has already paid this as rent. So subtract it from the total rental benefit is 438,615. 438,615. That will give you a total of 329,115. Now, this is what we're going to take as the taxable rental benefit, which then we add to the other taxable benefits. If we add to the other taxable benefits, we get a total of 3,253,215. This is now what is known as pensionable income. Pensionable income. Pensionable income. From the pensionable income, we deduct the allowable deductions. We need to subtract the allowable deductions. And in this question, there's only one allowable deduction, which is the pension deduction. Let us less allowable deductions. Whereby in this question, we have only one. That one is called pension deduction. And pension deduction, in this case, is the lower of. One is maximum, the commissioner's maximum, which is 240,000 per year. And then we have the actual, whereby the actual pension, in this case, is contributing to pension scheme, is contributing 15,000 per month. 15,000 per month means 180,000 per year. 180,000 per year. We compare that with 30% of the pensionable benefit. Compare that with 30% of the pensionable benefit. And 30% of the pensionable benefit, which is 30% of 3,253,215. The 30% of that is equal to 975, 964. Looking at the three, the lower of the three is the actual amount, which is 180,000. So we deduct the actual amount, which is 180,000. If we deduct that, then we are going to have a taxable income or a taxable benefit. We now have a taxable benefit, which is equal to 3,073,215. It is 3,073,015 and 215. That is now the taxable benefit. And it is on this taxable benefit that we determine the tax which should be paid. It is from this taxable income that now we determine the tax that should be paid by Mr. Wesonga. This is known as the taxable benefit. Now we determine the tax that is payable by Mr. Wesonga as follows. As we determine tax, let us refer to the tax table as below. This is the tax table for the year 2021, whereby up to, from 1 up to 288,000 is taxable at 10%. From 288,001 to 388,000 taxable at 25%. And from 388,000 onwards is taxable at 30%. That is the tax table we're going to use with a personal relief of 28,800. Let us go there. Tax liability. We start with the first. 288,000. 288,000 by 10. Next, 100,000 by 25%. Anything above 30,000, which is anything above 388,000, which is going to be 3,073,000. 3,073,215 minus 388,000 is multiplied by 30%. Now, the first one gives us 28,800. The second one gives us 25,000. And the third one is supposed to give us 805, 564. Now we determine the total of these. So that we get 1,118, 1,118,564. Then from this, we less pay as you earn. We less personal relief. We less personal relief. And we less insurance relief. Personal relief is 28,800. Insurance relief which we determine that should be the lower of. Insurance relief is the lower of. 1 is the maximum. And the maximum in this case is 60,000. Compare with 15% of the premium. The premium, we were told that Mr. Wesonga pays a premium of 15,000 per month. That is for the insurance relief, or for the insurance policy. He pays a premium of 15,000 per month. That should be a premium of 180,000 per year. Then we calculate 5% of the 180,000 per year. Right, so 15% of 180,000 per year, that should be 27,000. That should be a total of 27,000. Right, so that 27,000, so the actual 15% of the actual, which is 27,000. And now we compare the two. The lower of the two, which is 60,000 and 27,000. The lower of the two is 27,000. That is also deducted. So if we deduct the two, we deduct from 1,118,564, deduct 28,800 and 27,000. So that you're going to have 1,064,764. This is known as net tax liability. And from this net tax liability, there's some tax that has already been paid, which is known as the pay. So we less pay as you earn. Pay as you earn, in this case, we were told that the employer deducted pay as you earn of 47,200 per month. 47,200 per month. So we're going to have 47,200 times 12. 47,200 times 12. Which is equal to 566,400. Now, if we subtract that amount, we determine tax payable as 498,364. This is now what is tax payable, or what should now be paid by the employee. That is the amount that the employee should now pay to the tax authority. Having paid others through the employer, the remaining amount is now liable and outstandable on him. He needs to pay 498,364. And that is how to prepare a statement of taxable income in case of employment income. Remember, and in answering this question, I've adopted a unique kind of approach where I've provided very short notes explaining each and every item that has been provided here, which is derived from the Act. And that is how to determine the tax payable in terms of employment benefit. And that is how to determine the taxable employment benefit for the year.